In this video, I want to talk about a strategy we call selling a teenager. Now, if you're a parent, you know that that sounds like a very attractive strategy. Now, let's come in here and talk a little bit about selling a teenager and what we really mean by that. What we're talking about is options, of course, and I'm looking here at gold. And one of the reasons we like to sell options on gold is because it's got such a broad market. I mean, it's one of the markets that has the most broad set of premiums for our options trading that there is in the industry. All right, so we love trading options on gold because of the broad nature of the premiums. So let's come in here and take a look at this market. And it's pretty I'm not going to say any market is easy to predict the direction, all right? We do our very best at trying to predict market direction. We do our count, measure, setup, trigger, and follow through. We want to use the Elliott Wave counts and the measuring of our Fibonacci rulers, and we use the indicators, the bulls and bears, which is, very accurate in helping us identify direction. So we want to keep that in the back of our mind as we do this neutral option strategy of selling a teenager. Now, I've got an option on here already that's kind of in the way for our lesson. So I'm going to go ahead and I'm just going to liquidate that position. And let's get rid of that and take that money off the table. And we're going to come back over here to our charts. And you can see that we are looking at the gold chart, and we're anticipating that this market is going to either continue to drift sideways a little bit or, in this case, maybe fall a little bit. You'll notice that everything is neutral. Momentum is neutral. Stochastics is neutral. Even the directional moving average is coming down, or the directional moving index is coming down, showing that this market hasn't got a lot of trending potential. And you'll notice that the 50-day moving average, the market is coming right dead center through that, and it's crossing to the downside. Now, if we come in and we lay in here the seasonal nature of markets, you can see that seasonally speaking, we've kind of peaked up in here. We've reached our seasonal trend rally, and that's what we're looking at here. And then we're seeing this little dip right in here. And then from this point on, we're kind of seeing just a slow drift into expiration. Nothing really dramatic, but just kind of a slow drift into expiration. And so this gives us an opportunity to take advantage of gold as it kind of moves into expiration or into the end of the year time frame. And the other advantage is that we're going to sell a teenager, meaning that we have an option down here that is now a teenager. Okay, so it's 18 days until expiration. So those are the options that we're looking at. And there's a couple of strategies that we can do. We could do an iron butterfly, or we could do an iron condor. And really either the difference between the two is that we're going to sell a straddle or we're going to sell a strangle. And a strangle, of course, is when the market has your positions where you're going to sell them further out of the money, whereas a straddle is we're going to sell them right on top of each other. So let's come in and let's just work through an iron condor. Iron condors are a lot of fun, and I want to teach you a little bit about the probabilities, out of the money probabilities, the statistics that we have down here in the options chain. And so what we're going to do is we're going to come in and we're going to sell some premium, and we're going to try and collect a little bit of money from selling some premium. Then we're going to protect ourselves with the wings. So the easiest way to do that is just to come out, and what we do is we come to these numbers out here. Now notice this says probability of being out of the money, OTM, out of the money. So if we come out to a high probability of being out of the money, look at this. We've got out here options that are 90% chance of being out of the money, 91% chance of being out of the money at expiration in 18 days. Well, that's what I call putting the odds in our favor. Now, it's not very much money. It's $190, but that's all right. We can come up here a little bit higher. We can come up maybe if we're willing to take an 85%, 25% odds of the market being in our favor. We could come in here and we could sell an option for $330 and collect that premium with a chance of the option being out of the money of about 85%. 85% chance that market's going to be out of the money at expiration, meaning we'll get the entire $330. So what we do is we just go ahead and we sell one of those. But before we sell it, we want to worry about a little bit about our protection side. And we want to do our protection side first, just so when we're trading this and placing these orders, we don't get a big margin call in the meantime. So we can come out here and just think about this first. If we're going to sell this 1460, we need to buy a wing out here on our butterfly or on our condor to protect it. So $330, we're going to come out here, and if we come out, let's say 1, 2, 3, 4, 5, 6, 7. Let's see that. Look, we're going to spend $95 of our $333 or $330. We're going to spend $95 of that on picking up and purchasing an insurance policy. So let's buy the insurance policy first. So we're going to come in here and we're just going to place our order. We're going to buy that insurance policy. So what we've done is we just bought a put option, paid $95 for it. We're going to come up here now. Now we can sell this option. We're going to go ahead and we're going to sell this premium here, and we're going to collect $320. So we're going to put on, that's our one wing of our butterfly, and we're going to have that out there, and we're going to, in 18 days, if that market stays between our boundary in here, then we're going to have a $320 profit on the upside, and we're going to spend $100 just for some insurance policy in case that market does move beyond our boundary. And I'll show you our boundary here in just a second. So now we're going to come in, we're going to do the other side. All right, so we're going to come and put in another option on the other side, and the first thing we want to do is we just kind of want to balance it out. Now I showed you how to do that down here by looking at the options chain table. There's an easier way, okay, and we always like easier ways. Let's come in here and buy a call. So the way we do that is we just drag that on the screen, buy the call, and we want to put that up there, and we want to have it about the same distance as we did as we bought the put. So the put is going to be about the same distance, and we can come in here and measure that easily. First we can just come in here and do it this way, or you can do the math if you want to pull out your calculator. But we can see that's about a $7,800 move, and so we want to just move that same distance out, about a $7,800 move right in there, and so that's where we're going to buy our call. So we're going to come in here and we're going to buy our call very easily. We're going to go in, place our order, and we picked up a call. See how easy it is to buy options using track and trade with the drag and drop tools. So now we've got our protection out there. Let's go ahead and delete this out of the way. And now we need to sell our other options. We're just going to come in here and just sell a call. We just drag it on the screen. And again, we want it about the same distance away from the market. We can see over there that's about $500 that we're going to collect. We go ahead and we place that order, and we put on ourselves a beautiful little condor. All right, so we only have 18 days to go. And of course, we know the extrinsic value of these options, which is the time decay, will decay very quickly once they become teenagers at this point. Once they become under that 20-day marker, the time value drops off very quickly, which is what we want in our favor, is to have these $510, $320 move in our favor, and we want to collect that premium. We're going to pay for the insurance policy on the outside, $210 and $100, so we're going to give up a little bit of that premium just as a collection. If you wanted to, you could go out a little bit further and pay a little bit less for your premium, but it's kind of a mathematical model of where you are buying more insurance versus less insurance. Just like on your pickup truck, you might want to drive that thing around for years and years with no insurance, but eventually you're going to get smacked, and so you're going to wish you had really good insurance. This is the same way. We could, have real lousy insurance and pull these premiums way out here to where there's almost no insurance premium. But one of these days we might get smacked and wish we had better insurance. So you don't want to have too much insurance, just like on your pickup truck. You'll have a little deductible on there. Just in case that market goes against you, or you have a little deductible on there in case you get in a car accident, and you're willing to spend that little bit of a deductible when the market doesn't go in your favor. But in this case, we're putting the odds in our favor with the probabilities of being out of the money, as well as the time amount, the amount of time that we're using in the option, which is time decay, which is down there where the time decay is going to move very quickly. And the markets would have to actually move quite hard and quite fast and have some strong reason for moving faster than time decay. It's got to outperform time decay for this position to lose money. And our break-even point on here, if we draw our little break-even dollar calculator in here, we're going to see that it's going to be just somewhere right inside these green lines. Okay, and our probabilities on this trade are that the market is going to hit that purple line before it leaves this blue box. And that's kind of our break even. That's kind of our risk versus reward ratio. And that's what we're planning on having happen with this market. 18 days, it's got to stay inside that blue box. It's got to hit that purple line before it falls out of that blue box. Now, the real magic of this strategy comes in realizing that you can do this every single time a set of options come into expiration right around 19, 18 days. So every time you have a 19 or 18-day option expiration, whether it's on this market or any other market, you can set up yourself a systematic process of putting on an Iron Condor or an Iron Butterfly, either one, consistently every time the options come down to an expiration time frame of around 18 days. And then you can consistently put these things on. And of course, over a period of time, working with our odds that we've done here, where we have an 80% chance of being in the money, this is how options traders use this type of a strategy for consistent monthly income. Now, of course, you could put on multiples of these. You could put in, if quantity 1 is not enough for you, you want to put on quantity 2 depending on the size of your account. You could put on a couple of these and pick up a little additional premium over that time period. So there you go. That's selling a teenager or creating an Iron Condor in gold.